Between getting a vacant property and a lease property, there might be 30 to 40% uplift on your value, and it is not as active as property development, where projects take 2 years plus to realise. Hi guys, today's video is going to be another one on commercial property investment in Australia, and it's going to be on the differences between residential property and commercial property, because when I looked online, what I tended to find was that a lot of the information on there lacked a lot of detail. So I'm going to put my own personal spin on it in terms of the things that I think are different between commercial and residential property. I'm also going to talk about the advantages of commercial property and the disadvantages of commercial property. And while I'm at it, I may as well also tell you who I think, based on my property investment strategies, is most suitable for commercial property investment. Also, you aren't seeing things. I did get these put on the other day and I am learning how to talk with them, so I don't know how it's going to impact the audio quality, but that's a tangent. I just wanted to let you know, and let's get into commercial property investing. First things first is the price point. Now, with residential property, you generally invest around or just below the median price point with property. So that's around 600 to 800, depending on which capital city you are in. With commercial property, it's a little bit different. Now, to get into commercial property, you can buy something for $150,000. You can buy a warehouse or a little strata office. And you can do the same with residential. You can buy a $150,000 studio apartment. But with both of those investments, they are probably not prime and ideal. The difference with commercial property is that the prime price point for an individual investor is somewhere between the $1 to $5 million. Because under $1 million, you're tending to find that the tenants are not as ideal. And as you push up the food chain, the tenants get better, which in theory means that your property is of more value. What you tend to find with residential property is as you push up in the price point, the yield drops quite significantly. Whereas with commercial property, what the yield tends to do is stick alongside the purchase price. Moving on to the debt side, and more specifically gearing, commercial and residential property are getting more and more similar. And what I mean is, in the old days, the general rule was your gearing on commercial property would be around about 60%, and with residential property, it would be around about 80%. In some instances nowadays, you can get gearing on commercial property up to 80%, and on residential property, you can get gearing up to 95%. But residential properties gearing for property investors, particularly with bigger portfolios, has come back. So it's unlikely, if you have a large portfolio of 3, 4, 5 properties, you're going to be getting 95% gearing. And while we're talking about gearing, on the flip side of that is the deposit. So with residential property, you'll generally get a deposit around about 20% of the property's value. Then you'll allow about 5% of the property's value for purchase costs, which includes stamp duty. Whereas with commercial property, you'd want a deposit around about 30%, but the purchase cost will also be higher, generally around that 7%, because the cost of due diligence for commercial property is higher. And the final thing on the debt side worth talking about is rates. Firstly, the commercial market is a lot more competitive nowadays. There is a lot more lenders in that market, which has put downward pressure on interest rates. What has happened for large residential property portfolios is rates have gone up. So there's been a convergence because residential property has become more regulated and commercial property lending has become more competitive. The thing that has continued to be different is leases. So residential property, you almost never factor in the value of a lease. Whereas with commercial property, the value of the lease or buying income has become more and more apparent, particularly as interest rates have gone down. We've had this phenomena called cap rate compression, which I have talked about in the basics property investment video. I do speculate that Australian banks really make it hard to buy an asset when the lease in place is less than 2 years, or even harder when the building is vacant. This is why we're seeing that divergence between unleased property and leased property, which makes it an opportunity for the cashed up investor. It's a pretty common one, but one thing to talk about is gross lease versus net lease. So in residential property, yields are compared on a gross basis, whereby the landlord covers almost all of the holding costs of the asset, apart from some consumption. Whereas with commercial property, the tenant actually covers almost all of the holding costs of the asset. Really, unless it's a retail lease where there's some exceptions to the rule, the landlord only covers improvements or structural repairs to the building itself. Now let's move on to the difference between how you value a residential property versus a commercial property. With residential property, it's pretty straightforward. You use comparable sales evidence or use a rate per square metre on land. Whereas with residential property, you do use comparable sales evidence for unleased assets, but what you tend to find is most of the assets which are transacting are leased, and on those leased assets, you take into account the rent and then you apply a capitalisation rate. What we've seen over the years is that capitalisation rate has drifted down from somewhere in the realms of 7 to 7.5% on most assets on average. I'm going to call that average because people will call me out and say I'm wrong. On average, nowadays in most major capital cities, the same assets that have been transacting at 7.5% are transacting around that 5 to 6% capitalisation rate. The final thing worth mentioning in terms of the differences between commercial and residential property is how you rent it out. So with residential property, you employ a property manager. That property manager is paid by you. They go out, they find you a tenant, and then they help you collect the rent throughout the tenancy. With commercial property, it's a little bit different. There's two different people involved. There's commonly a leasing agent. They get paid to find you a tenant and negotiate the lease up front. This is commonly paid by the landlord. But once a tenant moves in, the ongoing property management is paid for by the tenant. There are an exception to the rule with respect to retail tenancies. The next thing we want to talk about is who is suited for commercial property investing. Well, you might already be a commercial property investor, particularly if you have a super fund and you have put an allocation towards property, whether it be Australian or overseas, because it's quite common to be invested in a real estate investment trust. The underlying asset in those real estate investment trusts is property. Now, I don't tend to believe that they're true property investments. That's a video for another day. So in my beginner's video, I talked about the 5 stages of property investing. You have the early stage investor, followed by the DINK, followed by the dependent stage, which then moves on to the peak earnings stage, which then moves on to the legacy stage. And what I tend to find is that in the peak earnings / legacy stage, you are needing to convert your capital growth into cash flow because you're trying to substitute your wage for return. And because commercial property is more weighted towards cash flow over capital growth, commercial property investing is well suited to people who are looking to substitute their capital growth for income. The other good thing about this peak earnings stage is if you've purchased good growth assets, you have equity. And what you can commonly do is draw out of that residential equity at residential rates and deploy that into commercial property. If you're going to go down the traditional route where you get a loan for commercial property, even though the spread between residential and commercial loans has become more converged, there's still a difference. And for those two reasons, where you're trying to get cash flow and you can deploy low cost of debt into commercial property, it is most suited for that peak earnings / legacy stage of investor. Outside of the later stage investors, there's also 2 other types of investors that commercial property may suit quite well. The first one is earlier stage property investors that have a large equity pool in residential property. Because of that reason of cheap debt, you might be able to draw out some of that equity and invest it into what's known as a real estate syndicate. The real estate syndicate is like a REIT in the sense that you have a portion of an underlying asset of a commercial property. The difference is it's much more liquid and much more tied to the property's value, and you're stuck in for a longer period of time. The cash flow returns are commonly higher than REITs, and the gearing is done inside the trust, meaning that if you're tapped out in terms of borrowing capacity for a future purchase, but you can draw out some equity, you're still able to get a form of leverage to buy commercial income producing property. That income, once it's on your tax return, then can be added back into income to service future debt. Another common investor that this strategy suits quite well is business owners, because they can buy a vacant commercial property, put their business in it, that business can pay rent, that rent effectively pays off the commercial property. The kicker from a lot of people is, and you need to speak to an accountant or financial planner, is buying it in your super fund, because the contributions that you make to your super fund every year, along with the rent, can effectively pay down the principal of that asset, meaning that as you come up towards retirement, you may have a commercial property that's totally unencumbered. I've glossed over this strategy quite quickly because I don't want to give any form of advice, but I'm going to touch on it again. You're making pre-tax contributions to your super fund, provided they're within that threshold. That is then paying the capital value of the asset down. There aren't many investments which allow you to do that. And for this reason, you should subscribe to my channel. So go down there, hit the subscribe button, smash the like button, and throw me a comment to give me motivation to produce more of these great videos so that you guys can learn more about all types of investment. So now let's get on to the advantages of considering commercial property. And the first one is yield. With residential property, the gross yield is 3 to 4%, and you lose almost 30% of that income to expenses when you're holding the property. With commercial property, the yield is net 5 to 8%, and the tenant pays all your outgoings. So you are 2 to 3 times better off from a cash flow perspective. Then there is longer leases. In residential, it's a 6 to 12 month lease. You don't really attach any value to it. Whereas in commercial, for 2 million plus assets, a 5-year lease is quite common. It's also worthwhile killing a fallacy and touching on a truism, and that's related to rent reviews. You can put a rent review in residential leases, but it's the fact that they're quite short. The truism is that the best part about commercial leases is if they have a long term and they have a fixed review with a ratchet clause, often the rent can outstrip what the market is willing to pay for that building over time. But you do have to be mindful for the fact that if you do that as a landlord, you are incentivizing your tenant to leave at the end of the term. It goes without saying that an advantage of commercial is that your property costs are covered by the tenant, meaning your property management fees, your rates, your land tax, all the other expenses when holding a commercial property, to the exception of retail leases, but the retail tenants still do pay a good portion of the building's outgoings. Now I wanted to get onto some of the ones that I didn't see really mentioned anywhere, and the first one is being able to license other forms of income. In residential property, it's unlikely for you to be able to rock up with an ATM, whack it out the front of the property and collect an income from an ATM. And to be honest, in commercial property, ATMs are becoming less and less popular anyway, but some other popular examples are you have a commercial property close to the city, it has some parking bays. All of a sudden, you can license those parking bays and receive an income. And the most popular one lately is solar panels. You, as a landlord, put solar panels up on your commercial property and you charge that tenant for the rent. You can't do that on residential property. Depreciation isn't commonly mentioned, and that's probably because the tax code only changed a couple of years ago, but it's worthwhile pointing out that with residential property, the depreciation is lower than commercial property. Provided you get all the advice correct from your accountant, you're basically getting $1 deduction today and you pay 50 cents of that back later when you sell the asset. Meaning that after tax, not only do you get a higher net income return from commercial property, the after tax income is also higher when you take into account depreciation. Make good is another area that's an advantage of commercial property, which is commonly overlooked because it's the income after income. So when the tenant moves out, you might do a settlement with them where they effectively pay you instead of making good, which can go towards the contribution to the next tenant coming in. The final one, which touches on make good, is repairs and maintenance. In residential property, it's up to the landlord to make sure that the property is maintained, whereas commercial property, it is almost entirely different. As a landlord, you have the power to put the onus on the tenant to make sure the property is maintained in a manner that's satisfactory to the conditions which you have put into the lease. And let's be honest, some of the repairs that tenants request on commercial property do end up being building improvements, which effectively adds to the capital value of your asset. So now we're all pumped up on the differences between residential property, the advantages, and who it is suited for. So let's let down some of your tires and talk about the disadvantages that I see in commercial property investing. Numero uno, and that is vacancy. And this does make many commercial property investors come unstuck. There is no hiding the fact that commercial property vacancy rates, on average, are longer than residential property. The leases are longer, but the vacancy rates are longer. Also, the outgoings is a lot higher. So when you inherit a vacant property as the commercial landlord, you inherit a lot more costs. The other kicker with this is banks often make the term of your loan very similar to the term of the lease, meaning that if your property does go vacant, the bank will get your property revalued. The bank may request more equity, they may jack up your rates because they know it's a lot harder for you to refinance once the property is vacant. This is just part of the game going into it, so make sure you have some spare gunpowder ready so that you're not put into a position where you may have to force sell that commercial property. The next one is a personal opinion which I like to chuck in, and that is the level of sophistication. First things first is most of the real estate agencies operating in the commercial space are tied in with a valuation arm, so they often see transaction flow, and for this reason they can often value up commercial buildings much better than your average residential agency, because your average residential agency isn't tied in with a valuation firm. In the residential development space, you can commonly pick up good deals where the agent hasn't priced up the development value into the property itself, where good deals in the commercial space often come from vendor motivation more than it comes mispricing of that property. Then we come to leasing a property, and another disadvantage is incentives. In residential property, it's unlikely to give the tenant any form of incentive other than maybe a week or two free rent in a bad market. Whereas with commercial property, it's quite common that the landlord will contribute to the fit out, will provide a rent-free period, or will provide some cash incentive to the tenant. This not only means you need to be in a position to cover the outgoings on a vacant asset, shore off the bank if they want more equity, you also need to have some cash to put towards getting the property leased up. The deposit and buying costs for commercial property are higher. This is multifaceted. Firstly, the deposits that you make when putting an offer on a commercial property is higher. Also, the deposit the bank would probably require for a loan would be higher, and the free cash that you need to be able to conduct due diligence is higher. Which gets me on to due diligence, and with residential property, people still don't get building inspections, but a lot of people do nowadays, which is good. With commercial property, it is much more thorough than just a building inspection. With commercial property, in addition to just the building, you'd look at things like the lease. Is it at market rent? The outgoings budget. You look at the plant and equipment of the building itself, and you look at the town planning requirements. Also, you might consider the tenant, you look at the guarantees and the deposit and the sponsor behind the lease, and then there's a raft of other areas which you might conduct depending on what type of commercial asset it is. Moving on to the debt side, it's another disadvantage of commercial property. It is improving, but borrowings is more involved to get on commercial property. It's not necessarily harder, it is more involved. The process is different. For residential property, it is a sausage factory. It's all in servicing and deposit and then the valuation, and basically you get a tick and flick. With commercial property, the process is a bit more involved, where you would commonly get a valuation up front, speak to a few different banks directly, and then negotiate on terms. Whereas with residential property, you take it or leave it. But don't let me let your ties down too much, which is a tongue twister to say with braces. The commercial property market is an awesome opportunity if you educate yourself, you're well capitalized, and you are ready to do the work to find the right assets. Because as I mentioned before, between getting a vacant property and a lease property, there might be 30 to 40% uplift on your value. And it is not as active as property development, where projects take 2 years plus to realize. So until you found your awesome next commercial asset or my next video, best of luck and goodbye.